What are some options to pay for long-term care? If you and your spouse can prepare for a possibility of long-term care ahead of time, you'll potentially be better off. You might not even need to implement your long-term care plan, but having it in place is an important part of planning. Once problems start, options become limited and it's hard to make good choices when you're in a reactive mode. Before making any moves at all, I recommend talking to a financial advisor who is well-versed in long-term care solutions, someone who's dealt with these issues many times. You'll also want to consider meeting with an elder law attorney who can help protect your assets when the bills start coming. That's especially important for the surviving spouse. And remember, it isn't just Alzheimer's or dementia that could devastate your family and their finances. It could be Parkinson's, could be a debilitating stroke, could be a car accident. We think these are worries for older people, but honestly, health problems can happen at any age. And as an advisor, I always like to let clients know what are the options and what they include. So number one, the option is traditional long-term care insurance. Much like term life insurance with long-term care insurance, you pay a stated premium. You have to be able to afford it. It can be expensive and premiums may increase over time, but you have to be healthy enough to qualify. And the insurance contract will state how you qualify for benefits, but often the buyer must need assistance with at least 2 of the 6 activities of daily living, for short called ADLs, such as bathing and eating, and also must be certified by a doctor. Many people don't start off needing nursing home care, so be sure your policy will pay for in-home care or an assisted living facility. Coverage will vary by policy, but frequently lasts for 5 or 6 years, and then you have to find another way to pay your bills. So even if you go with long-term care policies, you might consider layering other options. One of your layers of coverage could be fixed indexed annuities with a rider that offers enhanced benefits if you become ill. Again, be sure of what you're getting. All annuities are not created equal. Some will pay out 25% more than the income stream you were receiving. Some pay out 1.5 or 1.5 times your normal amount, and others will double. So for example, if you were receiving $20,000 annually from your annuity payout and you could no longer perform 2 of the 6 ADLs, you would receive $40,000 annually, usually until the qualifying account balance is depleted or the maximum amount of time, whichever is greater. After that, the payout would go back to the $20,000 that you were receiving. You can roll over funds from your IRA, 401ks, 403bs, tax-free to fund this annuity, and you can fund it with money from your Roth IRA or bank accounts as well. Riders are generally optional and many come with an additional cost. Make sure to consult with a professional to best avoid incurring penalties. Number 3, life insurance with living benefits. The life insurance industry also offers an opportunity to accelerate your death benefit to get the money you need if you suffer a terminal, chronic, or critical illness. The plus is, if you don't need care, is the death benefit will go to your beneficiaries when you die. There are several types of policies available, so be sure to work with a professional if you decide to use this alternative or consider it as one of your layers. The addition of an accelerated death benefit rider may require an additional fee, and they may be subject to eligibility requirements. The amount of death benefit that may be accelerated will vary by policy and will directly reduce the amount of benefit paid to the beneficiaries at the insured's subsequent death. Number 4, dividend-paying securities. The goal of these investments is more focused on income, not growth, which could add yet another layer of money when it's needed. One of the most important things I tell people I meet with is that if you sense something is happening to your loved ones, don't wait. If you haven't already, get your plan together and go to a doctor. Don't overestimate your ability to care for your spouse by yourself. Also, don't underestimate what it will cost to get help. Unchecked and unplanned long-term care costs could wipe out your nest egg. Medicare covers a limited amount of up to 100 days of cost, and to qualify for Medicaid, you have to spend down your assets to approximately $2,000 in most states. So it's important to be proactive. Talk about it with your family, meet with an experienced planner, and get with an elder law attorney to look at all your options. Then pray you never have to use the plan you put in place. We hope this information has been helpful to you. If you have any questions, feel free to contact our office to speak with an advisor at 1-800-381-8870 or check out our website. Also, don't forget to subscribe to our channel so you can view more videos just like this one. And remember, when it comes to your money, it pays to be strategic.